Silver is in an acceleration mode. It's not in a normal uptrend mode. So if one applies the normal technical metrics that say overbought, for example, ignore them. We're not in a normal market. A normal market meaning a normal bull market, that goes up in layers, or a trading range market that gets excesses both ways. Silver is in a seeking a new reality market is what the phrase we use. It's going into a new reality and it's going to do it suddenly. Silver saying, hey, I'm out of here. And the momentum already said that back in June. We said, okay, when silver was coming up toward that mid $30 level, it had been 35 and 35 in 2024 and 2025 early. And silver dropped down under 30 again, and it's coming back up in June of this year. And it was in the mid 30s, and we said, this time it's different. You're going to accelerate. And that was a momentum-based assessment, not just that price looked good. And sure enough, it zoomed past 35 and got up, up toward the old range highs, the $50. If gold merely goes to I did it again, or another eightfold move, you'd be 8,000 plus.
Momentum analyst Michael Oliver says silver is no longer in a normal uptrend, but has entered an acceleration phase that defies traditional technical indicators. According to Oliver, standard signals like overbought no longer apply because silver is moving into what he calls a new reality market. After breaking decisively above the mid $30 range, silver rapidly accelerated toward its long-term highs, confirming momentum signals first identified earlier this year. Oliver emphasizes that this move is driven by momentum, not speculation, suggesting silver's repricing could happen suddenly. He adds that if gold experiences a major expansion move, silver's upside potential could be substantial. Now, we present the clips from Michael's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Silver is in an acceleration mode. It's not in a normal uptrend mode. So if one applies the normal technical metrics that say overbought, for example, ignore them. We're not in a normal market. A normal market meaning a normal bull market, that goes up in layers, or a trading range market that gets excesses both ways. Silver is in a seeking a new reality market is what the phrase we use. It's going into a new reality and it's going to do it suddenly. Meaning, by our metrics, not judging the silver by its own dynamics, but the silver versus gold situation, which a lot of people plot the other way, the ratio. We divide silver into gold and express the answer as a percent. And back early this year, it was down to 1% silver ounce versus an ounce of gold, which if you go back 50 years, you see times when it's that low. You buy it because it's too low in relation to gold. In the 1979 to 80 move, which everybody remembers, that's when silver went actually from, it had been at a low around $3 or $4 and went to 50 over a couple of years. A lot of that compressed in the last couple quarters. In fact, a fourfold increase in the final two quarters of that move. And in 2001 through 2011, there was another bull market, but a lot of it was compressed in a couple quarters in September 2010 through April 2011, where several doubled in half in 5 months. Okay. But those were within that old range of reality. It's half a century of this. Okay. You've got some charts if you want to show them, but there have been other markets that over history, rare events admittedly, but have been stuck in price ranges. Copper's one, lead's another we've shown to our subscribers. Back in, this is just a good historical example. Copper was stuck in a range like silver between the 1970s, 80s, 90s, 2000 and 2005. The top of that range was about $1.50. And it suddenly decided, for whatever reason, unique to itself, because it did it on its own. It was not coincident with gold. It was not coincident with other base metals. Copper quadrupled in a couple quarters. And then subsequent to that, it overshot, it's no new normality, but it moved out of the old multi-decade range and did it like bam. Not in an incremental layered manner. Lead did the same thing in 2007. It had been in like a 40-year range, and it said, okay, I shouldn't have been here that long. I'm priced too low relative to, let's say, degradation of the money unit. So it did the same thing. It quadrupled in a couple quarters in 2007, and then subsequently lived in a new price reality that was roughly 4 times the price level of that average old price reality. Well, silver's been in that reality for 50 years. Why didn't silver coincident with copper in 2007 or 2005, or lead in 2007, or gold in its repeated eightfold bull markets goes well past the old high, and yet silver stays in the box. What's going on there? Well, there's arguments that it's been artificially restrained and so forth. But forgetting that, when a market decides to say, "Hey, I made a mistake," it quite often will compensate for the mistake by repricing itself rapidly. This is true with like bull market bubble tops, like in the stock market. Sometimes it crashes, okay? It compensates for it. It overdoes it. Well, silver's saying, hey, I'm out of here. And the momentum already said that back in June. We said, okay, when silver was coming up toward that mid $30 level, it'd been 35 and 35 in 2024 and 2025 early. And silver dropped down under 30 again, and it's coming back up in June of this year, and it was in the mid 30s, and we said, this time it's different. You're going to accelerate. And that was a momentum-based assessment, not just that price looked good. And sure enough, it zoomed past 35 and got up, up toward the old range highs, the $50. And now we've since blown that out. But its mode of advancement has accelerated, like you noted, the year to date. Few people are cheering that. They're screaming at every downturn. The difference this time is the silver gold ratio just broke out of a massive technical basing range where silver had been caught in a box since the early, like 2022, 2023, 2024. It kept coming back up to like 1.2 something percent of gold and go back down. So you could see it on a spread chart, which we've also sent to you. And when it broke out, that was the November close. And silver then was what, 44, you said, something like that? Yeah, where we last talked. Okay. Well, look what happened since. The month of December, you went, well, I think the November price close was in the mid 50s. So we gained, 10, 20, 30% in a matter of 4 weeks. What caused that? The spread broke out. And when you go back and look at that 79 explosion to 1980, where you quadrupled in 6-7 months, or the 2010 to 11 explosion, already in a bull market, but it exploded. Those lasted a couple quarters. We just broke out into November. So this clock is very young, and people aren't understanding that something different is going on.
Oliver says silver has entered an acceleration phase unlike a normal bull market. Traditional technical signals no longer apply as silver moves into what he calls a new reality market, repricing suddenly rather than gradually. Oliver highlights the silver to gold relationship, noting silver recently broke out of a massive multi-year base after trading near historic lows relative to gold. Similar to past breakouts seen in copper and lead after decades of price suppression, silver is now rapidly escaping its long-standing range. Oliver believes this breakout is momentum-driven and still in its early stages, signaling a fundamentally different market dynamic ahead. Let's get back to the interview.
If you go back and study silver on a logarithmic scale, not just a price chart, and gold on a logarithmic or ratio scale, and you go back to 75 when they legalized it, okay? Gold had a corrective low in 76 down near $100, 103. In fact, I was standing next to the pit the day that occurred. It was in August of 73 in the COMEX. It went from $103 to $850 in 3.5 years. That's an 8-fold move. Okay. And under conditions that are nowhere comparable to what's underlying the market right now in terms of massive monetary fundamentals. Then in 2011, after a 10-year run up, it had an 8-fold move from $260 to $1,920. 8-fold. Oh, interesting. Okay. Now we're 4-fold. Our bear market low was in 2015 at $1,050. We've gained 4-fold. Okay. Yet the underlying conditions are far more serious and yet to be unveiled fully. Some people realize them. And if gold merely goes to I did it again, or another 8-fold move, you'd be 8,000 plus. And even that's no big deal. So I throw that number out a lot, not because I'm predicting it. I think it's a nonsense number. You're going to get there and go way beyond it, especially when these underlying monetary factors become more bleeding obvious to the analysts and investors who are apparently oblivious to these factors. So 8,000 would be, so what? We did it twice before. I think gold could go way beyond that. So when you express the ratio of silver to gold or our percent scale of silver to gold, and you go to 3% of 8,000 gold, well, you put the number on it, But what if you go to 6% of 8,000 gold? Whoa. And what if gold doesn't stop at 8,000? Whoa. And plus you did the monetary factor there of M2. Okay. That's very interesting because it says, 200, I just matched the 1980 high. Well, when markets go from excess one way, in this case, is silver suppressed for too long, and goes to a new reality, it'll usually overshoot what should be that new reality. It overdoes itself. This is typical of market moves. So, it wouldn't shock me that if 200 is back to the 80 high, well, maybe you go to 500 before you settle back at 2 to 300. Okay, you get the point? So, and a lot of it because of our spread analysis, which I think is the key factor now. And also there's some other spreads that need to be looked at that just began. And those are the asset class breakouts, where gold versus the US stock market measured against the NASDAQ 100 or the S&P just blew through an 11-year wide spread base where it lived in a range up and down versus the S&P, where gold would rally versus the S&P and then pull back. But in net on balance, for 10, 11 years, gold was par to the S&P. People don't believe that. But you go back 10 years and gold was matching the S&P in ebbs and flows, but in a range that a kid with a crayon could draw. We broke out of that in October. That's a fresh base breakout spanning more than a decade. The gold miners did the same thing versus the S&P. Silver did the same thing versus the S&P. So these relative asset measurements tell us that monetary metals just broke out as an asset category versus the stock market. So the game just began. It's not over.
Michael highlights that gold has repeatedly delivered historic eightfold advances, rising from $103 to $850 in the 1970s and from $260 to $1,920 by 2011. After bottoming in 2015, gold has already quadrupled, yet Oliver argues today's monetary conditions are far more extreme. Using logarithmic and ratio-based analysis, he notes that silver remains deeply undervalued relative to gold. As monetary metals break out against major stock indices after a decade-long base, Oliver believes both gold and silver are entering an early-stage repricing cycle that could overshoot prior historical norms. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.